A stablecoin can trade for $1 even though it is not a dollar, a bank deposit, or central bank money, and the price is never literally frozen. On exchanges, it can flicker a little above or below its target. No hidden force handcuffs every buyer and seller to exactly $1. The peg works through incentives, access, and trust. Behind the calm price sits a machine. Money enters, tokens appear, tokens return, and money leaves again. When that machine is credible, $1 feels boring. When it is questioned, a few cents can become a siren. So the useful question is not whether a stablecoin promises $1. It is what makes that promise executable. At its simplest, a stablecoin is a blockchain token designed to track another asset, usually a national currency. But the target price and the market price are different things. One is a promise, the other is a negotiation. In the primary market, approved customers deal with the issuer or protocol to create and redeem tokens near the target. In the secondary market, everyone else trades existing tokens on exchanges, where ordinary supply and demand set the immediate price. The peg survives because specialized traders can move value between these two markets when a price gap appears. That makes the peg less like a nail through the price and more like a narrow corridor with guardrails. Consider a fiat-backed stablecoin. An approved customer sends dollars to the issuer through the conventional banking system. After the funds are confirmed, the issuer authorizes an equal face amount of new tokens on a supported blockchain. The blockchain records the new supply, and fresh tokens arrive in the customer's wallet ready to circulate. Meanwhile, the received money joins a reserve pool, often containing bank cash and highly liquid short-term government instruments. The token moves on-chain, while the backing usually remains off-chain with banks, custodians, and financial market infrastructure. When more approved dollars enter, more tokens can be issued. The circulating supply expands with the issuer's recorded liability. Redemption reverses the path. An eligible holder sends tokens back through the issuer's approved channel. Those returned tokens are removed from circulation, commonly described as burning, so they cannot continue trading elsewhere. The issuer then sends the corresponding dollars back, subject to its rules, banking access, processing time, and fees. As tokens disappear and reserves are paid out, supply contracts. The balance sheet shrinks on both sides. This ability to exchange a token for the reference asset is the hard anchor beneath the market price. But direct redemption is not always open to everyone. Eligibility, minimums, geography, and compliance can separate users from the anchor. Now imagine the token becomes scarce on an exchange, and buyers push its price slightly above the target. A market maker sees a gap. Acquire newly issued tokens near the anchor, then sell them for a small premium. Fresh supply moves from the primary market into the exchange where demand is strongest. Those sales increase available supply exactly where the premium appeared, pressing the exchange price downward. The profit may be tiny per token, but large volume makes the trade worthwhile and the correction powerful. Competition continues until costs, limits, and risk consume the opportunity. The token drifts back toward its corridor. The reverse trade matters more during fear. Sellers can push the token below its target on the secondary market. If redemption remains credible, arbitrageurs buy discounted tokens because each may still be exchangeable near the promised value. They carry those tokens back across the bridge and submit them through the primary redemption channel. Receiving more from redemption than they paid in the market converts the discount into profit. Their buying absorbs tokens from frightened sellers, while burning redeemed supply removes some of the excess permanently. Again, the trade fades when fees, delays, access limits, and remaining doubt become larger than the price gap. For fiat-backed stablecoins, reserve quality is not a footnote. It is the machinery that makes redemption believable. A reserve can look valuable on paper yet still be slow, risky, or expensive to turn into cash quickly. Cash and short-duration government instruments are generally easier to mobilize than long loans, volatile assets, or opaque receivables. Even adequate reserves can face a timing problem when redemption requests arrive faster than assets can be sold or transferred. Reserve disclosures and independent assurance can reduce uncertainty, but they must be read with scope, timing, and legal structure in mind. Most importantly, backing is useful only through an enforceable path connecting reserve assets to actual redemption. A debug often begins before any final accounting verdict. A rumor questions reserves, banking access, or redemption speed. Holders sell first and investigate later. The secondary market price falls as everyone reaches for the same exit. Normally, arbitrage would close the gap. During stress, queues, closed banking hours, fees, and uncertainty can slow the bridge. The discount becomes a live estimate of delay, access, reserve loss, legal risk, and the chance that redemption fails. If redemptions continue, the issuer must mobilize reserves rapidly, turning a confidence problem into a liquidity operation. Successful redemptions can restore confidence. Delays or losses can do the opposite, creating the logic of a bank run. Not every stablecoin stores dollars with an issuer. Crypto-backed systems try to create stability from on-chain collateral instead. Because crypto collateral can fall quickly, users generally lock more market value than the stablecoins they borrow. That extra collateral is a shock absorber, giving the protocol room if asset prices move against the position. If the buffer becomes too thin, automated liquidation sells collateral to repay debt before the position becomes dangerously underbacked. Price oracles tell the protocol what collateral is worth, making oracle quality and market liquidity part of peg security. Some systems also use fixed-rate swap modules, letting traders exchange approved collateral for stablecoins and close smaller price gaps. Algorithmic stablecoins push the idea further, trying to manage the peg mainly by changing token supply and incentives. One common design links the stablecoin to a volatile companion token that absorbs expansion and contraction. When the stablecoin trades low, the protocol may let users destroy it in exchange for nominal value in the companion asset. The stablecoin supply shrinks, but new companion tokens enter circulation. The mechanism transfers pressure rather than deleting it. This only works while the companion asset keeps enough value and buyers believe the system will recover. If confidence breaks, redemptions mint more companion tokens. Selling pushes their price lower, and every new rescue becomes weaker. That vulnerability became history in May 2022, when confidence and liquidity around TerraUSD deteriorated and holders rushed to exit. The design converted escaping stablecoins into newly created Luna, increasing the supply of the asset meant to absorb the shock. As more companion tokens were created and sold, their market value fell, requiring still more units for each attempted redemption. Falling value demanded faster issuance. Faster issuance caused more selling. The stabilization loop became a death spiral. Once traders doubted the asset received in redemption, the theoretical $1 exit stopped functioning as a trustworthy anchor. The Federal Reserve later described a run and complete collapse within days, wiping out the stablecoin and much of its companion network. To evaluate any stablecoin, start with redemption. Who can return it directly, through what channel, and under which restrictions? Then, inspect the backing. Cash, short government instruments, crypto collateral, loans, another token, or merely an algorithmic promise. Ask whether those assets can become spendable cash quickly enough during a rush, without taking damaging losses. Look for timely disclosures, independent assurance, clear custody, and a legal structure that connects holders to the reserve. Remember that an exchange quote reflects immediate trading conditions, not an automatic verdict on the final value of every reserve asset. A stablecoin is an engineered bridge between blockchain markets and another unit of account. Bridges depend on foundations, traffic, and maintenance. The peg is not a magical property stamped onto a token. It is a process that must keep working under pressure. If you want more crypto machinery explained without the smoke, Follow StickChain. Do not panic. Just watch. Subscribe.